And we are back with another episode of the Pursuit of Progress podcast. I'm Adam Lang, as always, with my co-host, Ben. Ben, really excited to have you on again today, as always. What's going on?
Hey, I'm excited to be back. Fridays are always great, so excited to be joining everyone on a Friday. And you know what? I'm really excited about what we're going to be talking about today: real estate, interest rates, inflation, and exciting trends in home buyer behavior. So I think we have a lot of great content today.
Yeah, one of the things I really enjoy, specifically talking to you about this type of content with, is that you're really good at just kind of dumbing it down, and I say that with respect because I'm somebody that needs some of this financial literacy type talk just to be, said in a very easy to comprehend manner, and I think you do a great job at that. So I'm excited for other people to get some value out of that today as well. So let's go ahead and just jump right into this. We'll start off just talking about mortgage rates, since that's something that's probably on everybody's radar, just with the news and how it's just a constant talking point on both national and local news. I believe as of earlier this week, we were pushing 7.25, maybe even up as high as 7.5% right now with the current rate for the 30-year fixed.
Yeah, I quoted a rate last Wednesday, and the rate, and this was for a prospective home buyer, it was 6.75% on a 30-year fixed. By the time they went under contract on a Friday, it was 6.99%. And, they wanted to kind of just wait and see what happens. And over the weekend, the rate had gone up to 7.125%. And so still there's been a lot of movement, and a big reason for that, for this most recent, is because of the inflation report from last week. It's really had an adverse impact on interest rates in the short term right now. But going back the last 2.5 years, really January 2022 is when rates started to increase. And it has been relentless. I mean, this interest rate market, this mortgage market, usually there's a little give and take. Rates go up and then they kind of pull back or they stabilize. And it's really just been up and up and up. We did hit around 8% back in November, December 2023. So we are down off of those highs. But when you look at where we started, January 22, we were still in the twos, and now we're back up in the sevens. I mean, that's a very, very significant move up.
Yeah, I wish that the media hadn't reported so much, and I'm sure they legitimately thought this was the case. But at the beginning of this year, there was so much talk about when we were at the 6, or we were at like the 7% range, maybe even the low, maybe even high sixes to low sevens. This talk about over the course of the remainder of the year of 2024 that we would see potentially up to 1.5% of a drop, getting back into the low fives. And ever since that was basically publicly announced and got all the real estate agents, lenders, just everybody that's interested in buying a home, it's gone the complete opposite direction. There haven't been any rate drops. And in fact, it's gone up instead of down. So that's been a little bit of a frustrating point for especially us that are in this industry.
Yeah, that's absolutely right. And there are so many different economists, bank analysts that were predicting the same thing. From everything that I read, really everyone was predicting that rates would start to come down Q1 of 2024. And that was after they were already supposed to have started to come down in like 2023. So it's gotten pushed back several times. Then it was supposed to be like Q2, Q3 of 2024. And now the Fed is saying, there may not be any rate cuts at all in 2024. And so it's really just an interesting perspective. And I'm one of those loan officers where I'm not, going to go guarantee or tell someone that interest rates are going to come down. I want them to do what is right for them today, but then also know that if rates do come down, they have the ability and the opportunity to refinance to a lower rate, but there's never a guarantee of that. So you just want to make sure that you're making an informed financial decision based off of the current market trends, but then also understand what the implications moving forward are.
And just to give our listeners a little bit more context, and to be honest with you guys, myself as well, maybe Ben, you could just talk a little bit about just how the interest rate is determined. I know that Glenn Powell is somebody that has a lot of influence. Everybody's always awaiting what he's going to be talking about when it comes to, predictions and inflation and mortgage rate, all this kind of stuff. But, what is moving the needle? Like, what is the contributing factors that are making the rates go up or down?
Yeah, so the Fed, when the Fed changes the Fed funds rate, what that means is that is the short term interest rates that banks lend money to one another. And as those increase, they don't directly impact long term rates, but they definitely influence long term rates because all of this stuff is tied in together. And so you'll have long term bonds and yields; those will start to rise, and then that's where it really impacts the 30-year fix. So by that Fed funds rate increasing, that indirectly impacts mortgage interest rates like the 30-year fix. And that is why we have gone from the 2.99% back in January of 2022 to 7+% where we're at right now.
And then obviously the second most talked about buzzword right now outside of just, mortgage interest rates is inflation. Just
Mhm.
help us kind of, again, just dumb this down, just simplify this as much as you can if you could. Just talking about just how inflation is affecting interest rates.
Yeah, when you think of inflation, what you really want to think about is what can your dollar buy today and right now. And so over time, the value of a dollar, or maybe it's easier to think of $100. What can your $100 buy? And the reality is your $100 today in 2024 is worth a lot less than what it was in 2020. So that $100 bill hasn't changed. That's still the same. It still has Benjamin Franklin on it. But what the value and what you can go purchase with that $100 bill, you can get a lot less in 2024 as far as value, services, goods, than you would have been able to get in 2020, and that's normal. What's not normal is the rate. So another way to think of inflation is the rate at which our dollars are deteriorating. And so our dollars are deteriorating. The value of the dollar is deteriorating at a much higher rate than what it has in the past. Over the past couple of years, we had inflation hit 5, 6, 7%. Where it really needs to be is around 2% or less. The target outlook for this year and what the Fed was hoping for was right around 3%. And the forecast for this most recent data that was just released last week was 3.2. Well, the report came out at 3.5. And that might not sound significant, but it really, really is. And it's just too high. And so what that means is that the cost of goods and services are increasing at a rate to where that value is just that the value of the dollar is really just getting eroded much, much faster and much quicker. And that's a significant concern. And so when interest rates come down, there's a tendency or possibility that inflation can increase even further. So the fact that inflation is still not at the levels that it needs to be, where it's under control, it is now a little more unlikely that the Fed will reduce rates because all of this is tied together. So because when rates come down, consumer spending usually goes up. And when consumer spending goes up, that is a spur for inflation. So they don't want to reduce rates because that will likely increase consumer spending because that credit card interest rates will come down, mortgage interest rates will come down, auto loan interest rates will come down. There'll be more spending in the economy, which is good, but it's not good for inflation.
Gotcha. Yeah, I don't have the specific the statistic, but I think it was like either the last 12 months or maybe it was the last 24 months. The value of the dollar was like 80% of what it was 2 years ago. It was some crazy number,
Yeah,
which
and
is
that's when you look at and this is why I'm such a big believer in saving and investing. And in 2024, like you have to learn how to invest if you are ever going to plan on retiring. Like you have to learn how to invest your money. Let me share a quick story with you. My mom was a single mom with three kids on a single income. And in the mid 90s, she was able to buy a home on her own with her own income in Wheat Ridge, Colorado, which is a really nice area. And she was able to qualify for that home. She was able to purchase it on her own, and she was able to afford it on her own. And that's because affordability, was very different back in the 90s compared to what it is right now. That there is no way. And she was someone who did not have a high income. She had an average or below average income. She was good with her budgeting, and she did not finance a lot of things. So from that perspective, she was very strong, but she was not someone who had a very high income. Um, and here in 2024, when you look at the cost of real estate and affordability, but then when you look at all these other costs, sending your kids to college, student loans, and how much, I mean, that has gone up a shocking amount. I mean, that is insane. And I don't feel like enough people are talking about that. The value of a college degree, I mean, that is eroding. That is eroding right before our eyes because the costs are so high. And I'm very big on this. Like, you can't just say, like, you need to go to college because, so you can go get a degree and go get a good job. And no, you have to be very, very intentional with that now. And then when you just look at normal prices of goods, grocery store items, purchasing a vehicle, gas, all of these costs have risen so much, and all the dollars are just flowing out of the consumer. So,
Yeah.
you have this American consumer, wages have gone up, but they haven't gone up that much compared to the last couple of years. So now rent has gone up significantly, or mortgages have gone up significantly. The average auto loan for a new auto loan in America right now is over $700 a month. That's an outstanding number. You go to the grocery store, that's higher than it's ever been. You want to send your kids to college, that is higher than it's ever been. And the part that really bothers me, I don't know if you've seen this, there are so many more restaurants now, and not just restaurants, but retail places that are now passing that credit card convenience fee of 2 or 3% onto the consumer because the
I haven't seen
merchant
that.
they don't want to pay for it. So now they're passing it on. And so the consumer is just getting taken advantage of at every single corner. And that has to stop. And the only way that it can stop is the individual has to take control of their finances. They have to learn how to save and invest, and they have to stop being emotional with their money.
And you guys obviously were, very strong proponents of real estate, but just on this topic, there's very, very much a high level of value in diversification. And what I'm referring to is this value of the dollar, going down every year. However, you need to figure out a way to hedge some of your savings against that if you're ever going to come out ahead. If you're just somebody that just saves every dollar and just puts it into a savings account that's getting you, a quarter or a half a percent of, growth through your bank, you're not going to outpace that difference with the inflation and just that value of your dollar year over year. So obviously real estate is a long-term investment. It's not liquid. It's not very easy to take cash out of your real estate unless you maybe get a HELOC or something like that. But
Mm-hmm.
just having that mindset of diversifying some of your money if you're in a position where you've got all your credit cards paid off and you're financially stable, but just that idea of if you ever are going to be getting ahead in the life, you need to think of some ways to put your money somewhere where it's working for you to hedge against that devaluing of the dollar.
That's exactly right. The worst thing that you can do with your money is just let it sit in a low yield savings account. It's just literally deteriorating before your eyes and losing value. Now the number in the savings account isn't going to go down, but the value is going to go down. And that's what people don't understand. You are never going to be able to save your way to wealth. You have to put your money to work for you. And there's a lot of different ways to do that. But it's about really what it comes down to. Like, if you are someone and you understand the concepts of building wealth, if you are willing to save and learn how to save and invest a percentage of your income every time you get paid, you will become wealthy. And these are the principles I'm teaching my kids right now. I don't care if you get money for your birthday. I don't care if you get money for Christmas. I don't care if you get money for your allowance or for a side job that you do. You need to take a percentage every single time you get paid, save that, and learn how to invest it. And if you are always doing that, if you always develop the habit of doing that, over time, you will become wealthy.
My tip on that one is, most large banks, probably even at this point, smaller banks, credit unions, they offer what's called a sub account where you can actually open up your primary checking, your primary savings account, but then also create sub accounts underneath that and actually have the bank set up where when you, for example, if you're a typical W-2 employee and you're getting direct deposit paychecks, when that money comes in, you can have it set up where they're automatically taking 5% of that dollar amount being deposited and putting it into sub account A, which is maybe for your child's college fund, or maybe
Yeah.
another 5 or 10% for rainy day fund for your vacation and travel and just fun stuff. But
Hmm.
I'm speaking out of personal experience. I'm saying this as a I'm not perfect at this either, but if you don't do that and you just rely on yourself to just on your own accord deposit money and then move it into these different accounts, very few people have the discipline and are just totally 100% honest with themselves to do that correctly and not cut some corners and oh, I'm going to take a little bit more out this month. There's a festival I want to go to this summer, music festival, whatever it may be. But I think just the more structured and more of a fixed process behind this will save you guys so much just time, take the emotion out of all of this, and really be a good first step towards preparing yourself to do these types of things.
I'm so glad that you brought that up because I just did a video on this on my YouTube channel where I talked about the importance of this very thing, about having a really strong payday routine. And, it comes back to having a financial vision and a financial plan. What you want to do is every time you get paid, you want all of that to be automated. So every time you get paid, a percentage is going to your 401k, a percentage is going to your real estate fund, a percentage is going to your stock fund. You're constant when you learn how to constantly pay yourself first and set that money apart and it's automated and you don't have to think about it. That's how I have my personal account set up. Now, you might be thinking, well, I don't have money to invest in my real estate fund or my savings account. Yes, you do. And remember, it's not the dollar amount that matters, it's the philosophy that matters. And so for myself, for example, I started building out these habits years and years ago, decades ago. And when I started doing that, I didn't have a lot of money to invest. A lot of times it was just a couple bucks, but it's the routine and the habit that is what's most important. And as your income increases, as you develop that kind of that self-awareness and that self-discipline when it comes to your finances, those amounts will increase. And that's where it just gets exciting. You can really start to build something. And then as it's always based off of your starting point. When you can, when you started at zero and after 10 years, you can look back and say, you know what, now I'm a homeowner and I have this much in my 401k and I have this other stock account. All of a sudden, you're talking about hundreds of thousands of dollars, maybe even millions. And it's all part of your payday routine.
Yep, it's a slow game. It's not something that happens overnight, but that compounding over time, you see significant growth if you just stay diligent and just persistent with this type of stuff.
Hmm.
So let's go
Yeah.
back to. Oh, sorry. Go ahead.
I was just going to add one thing there. What gets a lot of news in America is income and income inequality and affordability. Now, one thing that I always say is that it's not just about the income; it's also about your debt and your living expenses. And that's why you have to be very careful about what type of debt you take out and when you take it out. And I would like to encourage everyone just to be very cautious when taking out auto loan debt. I personally do not believe in financing auto loans ever under any circumstances. That's a belief that I have. I'm also very, very cautious when it comes to student loan debt as well. And the reason for that is because the student loan characteristics of that debt are just so toxic. Once you have that debt, there is no way to get rid of it. A lot of times it can negative amortize where the balances can actually grow over time and get bigger. And it's something that a lot of people just don't understand. And that's one of the problems that Americans have, is that we have so much debt. And then of course there's credit card debt. We have our national credit card debt right now is literally trillions. And so when you have all of your money, when you're getting paid, going to all these different things, your credit cards, your auto loans, your student loans, it's going to be really hard, if not impossible, to build wealth. So everyone always focuses like it's an income problem, but it's not an income problem. It's actually a financial behavior problem that is tied to poor financial choices with consumer debt.
Love that. Yep. Yeah, without being educated on this and just having a pulse, if you can't measure it, you can't manage it. And just being in a position where you're just going off the cuff and, oh yeah, I'll pay for this, pay for that, put it on the credit card, just having zero awareness on what's actually happening in that situation. It's great to just take all this questioning out of this and just have it as part of a process. So definitely recommend you guys, just start small. Just even just open up one or two sub accounts, just something that just gets the ball rolling when it comes to this topic. I think that would be very beneficial, not only today but in the long run down the road too. Ben, I'd like to, if we could, just kind of go back for a minute on mortgages and
Yeah.
talking about just the current rates. And there's been some buzz just in the news over the last few months. I've noticed it more than in the past about this concept of a 50-year mortgage, or even I've even heard people talk about a 100-year mortgage. And just maybe get your perspective on if that makes any sense at all, if that ever were to come through and pass and be something that was available to people. And this is, comparison to the 15-year and the 30-year fixed that are currently out there.
Hmm.
And just talk maybe a little bit about just the real numbers behind this, and is it significant? Is it even something that would make much of a difference? Just kind of your overall perspective on this.
Yeah, it's so interesting because FHA right now, on their loan modifications, they allow for a 40-year term. And so you're already seeing some of this kind of placed into the market. Now, of course, 15 years ago, we had interest only mortgages that were very, very common and part of the everyday market. I have heard Grant Cardone talk about this, the 100-year mortgage. And let me just run some numbers by you really quick. So let's look at a $500,000 mortgage, and we're going to compare the 30-year fixed mortgage to a 50-year mortgage, and then also a 100-year mortgage. Because it's, I think a lot of people out there are thinking a 100-year mortgage, oh, well, my payment is going to be, you know, it's going to be so affordable. It's going to be so cheap. Like that sounds like such a great opportunity. The 100 years might be a little bit of a turnoff, but they're thinking like, oh, I can go buy any home I want because it's amortized over 100 years. Well, let's run the numbers. So right now on a $500,000 mortgage, and let's just we're going to use an interest rate of 7.25%, and that's amortized over 30 years. The principal and interest payment would be $3,410. That's on a 30-year. Now let's amortize that over 50 years. So a 50-year mortgage. Guess how much the mortgage payment would come down to on a 50-year mortgage?
So instead of 3,400, I mean maybe 3,000.
3,100. So
So
it would be $300 cheaper on a 50-year mortgage than a 30-year mortgage. Now let's compare the 50-year mortgage to a 100-year mortgage. So the 50-year mortgage is $3,104 a month. Now we're adding another 50 years. So we're going from a 50-year mortgage to a 100-year mortgage. Guess what the principal and interest payment on that would be?
I would just guess maybe half since it's twice as long. So maybe $1,500.
3,023. So the 100-year mortgage would only be, roughly $80 a month less than the 50-year mortgage. And so that's where it's not, and the cheapest mortgage that you could have would be the interest only, because on a 50-year and a 100-year, you still are paying principal. But on a 50-year mortgage, you're actually not, or on an interest only, you're actually not paying any interest. So the interest only payment on that would be $3,020 a month. And so that's the part that I think is not getting communicated, because I have heard that. I've seen clips on that. I've heard Grant Cardone specifically talk about that. And there can be a little bit of cash flow savings, but it's not going to be significant, and it's not going to be something that I recommend. You want to be able to get your mortgage paid off in your lifetime, and a 30-year mortgage. I'm a believer. I never finance anything shorter than 30 years, and the reason for that is because I'm more concerned with the number one, the financing terms on a 30-year compared to a 15-year are almost the same. The 15-year it has a slightly better interest rate, but it's not like if the 30-year interest rate 7%, the 15-year is going to be 3%. That's no. If the 30-year is 7%, the 15-year might be 6.5. Usually a half point to three-quarters of a point. That's really not that significant. And on a 30-year, I still have the ability to control the interest rate and pay the loan off in 15 years. And so I still have control over that. I still have control over the cash flow. If I want to make additional principal payments and save on the amount of interest and turn that 7% into a 6.5, I have the ability to do that. But when you go down to a shorter term, you are then locked in to the 15-year payment, and you don't have the option of having the lower payment. So I always do the 30-year, but at the same time, though, I'm not going to go higher than the 30-year either, because the 30-year is just a really good balance. I am paying some principal. I do have the option to pay additional principal every month, but it's like I want to get this, like a 50-year. Like if I got into a 50-year mortgage right now, I would get that paid off when I'm 90.
Yeah.
Now I am
Or getting
planning
it as
on
a
living
burden.
till 150 years old, just so you know. But it's like, you know what? So technically, I still could get into a 100-year mortgage, because then I'd be 140. But I want to get this paid off sooner than that.
Yeah, I think that's probably a smart move. So let's just talk one last topic before we close out this episode. There's a lot of people right now that are feeling kind of beaten down, want to buy a home, but just feel like it's just not in the cards for them.
Yeah,
Whether it be just the cost of real estate in Colorado right now being, very, very high compared to the amount of money that people are making, but also just this interest rate, this topic that we've been talking about. What are a few, things that you're seeing in the industry right now that are allowing people to still make the deals work? And I'm kind of just prompting you to maybe talk a little bit about like a 3-2-1 or a 2-1 buy down, just explaining that again in kind of a simple, easy to understand way for people that maybe aren't aware of that and don't even know about that as a potential way for them to use as a negotiating tool to hopefully still, get a home today for a rate that's maybe more in line with what they were used to a year or two ago.
yeah, that's a great question, and I'm glad that you asked it. Right now in this Denver market, affordability is the name of the game, and that is the number one challenge that home buyers are having, and especially first-time home buyers. And the reason for that is because property values are near or at an all-time high, and interest rates are near or at really a 20-year high. So when you have higher home values and you have higher financing rates, it creates mortgage payments that are much more expensive than what they were, especially coming off the historic lows. And so that is the challenge right now in today's market. Now, having said that, there are opportunities, and this is what is not getting discussed enough, because are there challenges? Yes. Is affordability a challenge and a problem right now? Yes, it is. But there are opportunities. And so one of the opportunities is that buyers have more leverage than they've had really in the last 15 or 20 years. What I'm seeing on my end, I haven't done a temporary buy down loan up until about 6 months ago, my entire career, because there's never
Wow.
been a need for it. And all of probably 50% of my closings right now are buy downs. And what that means is that the seller actually pays for the buyer's interest rate buy down. And so, for example, I'm working on a deal right now. The seller is contributing $15,000 to pay for the buyer's interest rate buy down. So in year one, on that 3-2-1 buy down, the note rate is 7%, but the customer is getting a 4% in year one, a 5% in year two, a 6% in year three, and then starting in year four, that's when the loan will mature and go to the 7%. The benefit of that is that they're going to be saving around $700 in year one, $500 in year two, $250 in year three. And that entire $15,000 that the seller is contributing is going right into the buyer's escrow account. So that is the buyer's money that is going to be held in their escrow account or their mortgage savings account by their loan servicer. And this is also something that no one talks about. In the event that interest rates come down, let's say, for example, that interest rates come down a year from now, whatever amount is in that escrow account for the original buy down. So say, for example, that interest rates right now are 7%, and say that they do come down to like 5.5%. And let's say that this buyer wants to refinance, even though their interest rate in year two would be 5%, they want to refinance into a 5.5% because they can then get that for 30 years. Well, if there's $10,000 left from that original buy down subsidy, they get all of that money back. They will either get a check back at closing once their loan is paid off, or they can have it applied to the principal balance and have it reduced off of the principal balance of their loan. So it's a great way to hedge the market and also keep your monthly payments a little bit more in line with what your goals are. And it just allows you to kind of grow into the home and grow into the payment a little bit, but still have the benefit of getting to play the real estate game.
And I know there are restrictions. I can't remember what the dollar amount is, but there is a cap on how much can be applied for a temporary buy down. Is that correct? Is it 15,000? Is that the limit?
Yes, the different loan programs have different limits as far as what the seller can contribute. So it does depend on the loan program. But what's great though is that these buy downs, they are available on conventional loans, and they're also available on FHA loans. And we've done them both on conventional and FHA. And a 3-2-1 buy down, it may not always make sense. It is going to allow for a much, you do need to get a much larger seller contribution for that to make it work. But there's also a 1-0 buy down. There's a 2-1 buy down. So there's multiple options here to keep the interest rate lower and keep the payments lower for either 1, 2, or even 3 years.
Yeah, definitely stuff that should be talked about if you guys are considering buying a home. Definitely reach out to your lender and also your real estate agent just to get a little bit more educated on these as potential options for you and some negotiating tools when it comes to how you're structuring your offer and what you're asking for the seller to contribute. Maybe rather than having them reduce the price of the home, you incorporate more of a seller concession like we're talking about, and
Yeah.
applying that towards a buy down.
Yeah, and that's something that a lot of buyers don't understand. I'm glad that you brought that up because, most buyers think, well, why would I, if the home is listed at 500,000, wouldn't it be better if I can just buy the home at 485,000 versus 500,000 and getting a concession for 15,000? And it sounds counterintuitive, but the concession goes so much further than if you reduce the sales price to 485. The reason for that is because down payments are percentage basis. So if you're putting 20% down on a $500,000 loan compared to 20% down on a $485,000 loan, well, the down payment change is very, very minimal. So your down payment, even though you have a lower sales price, is going to be almost the same. Same with the monthly mortgage payment. Because it's amortized over 30 years, if you're talking about a $15,000 difference between the sales price between a 500 and 485, the amount of mortgage, the mortgage payment is going to have a very insignificant difference. I mean, we're talking like, $50 to $60 a month. Whereas if you get a $15,000 credit, you can use that to pay for all of your closing costs. You can do a temporary buy down and literally save, multiple hundreds of dollars in year one. You can do a permanent buy down as well. So you can you could have all of your closing costs paid and not come into closing with anything out of pocket other than your down payment. So you have a lot more options, a lot more flexibility when you get that seller credit.
That's awesome. Nice. Well, I think those were some good, valuable tips for people that maybe aren't as versed on some of this stuff. So hopefully you guys learned a thing or two and got some value out of this. I think that's going to wrap us up for today. Before we leave, though, quick plug on my end. You guys, would love to connect with you. If you have any questions when it comes to real estate, feel free to reach out. We could set up a 30-minute strategy session. I do a lot of these over Zoom and just learn a little bit more about unique circumstances and find a few different ways I can provide value today, whether it be looking for a home now or 6 months or even a year or more out from now. So it's just great to, again, be prepared ahead of time and educate yourself today. So when the time comes, you're ready to take action. And Ben, I know you've got a very, very cool YouTube channel that's continuing to grow and getting a lot of great value for your subscribers. Tell us a little bit about that.
Yeah, my YouTube channel is American Money 101, and I, as a banker, mortgage banker, and a loan officer, the reason that I started that is because I look at people's credit all day long. I look at their pay stubs, their income, their tax returns, and I just see so many people making the same mistakes every single day. And the reason for that, I don't blame them. It's because there's never been any education when it comes to financial literacy in our education system. Literally, no one has been taught this stuff. I wasn't taught this stuff. I had to learn it on my own. And so the point of the channel is to help folks with financial literacy, help educate them on things on, financial behavior, credit, how to improve credit, payday cycle, payday routine, what books are of value, how to educate yourself, emotional and financial discipline. So it's more of a passion for me. I just want to help people build wealth, stay out of debt, and live their very best financial life.
Love that, man. We need more people like you in the world. Well, guys, with that, we're going to be closing us out with the Pursuit of Progress podcast.
The Pursuit of Progress.
Great to see you guys today. Look forward to connecting with you guys again next week on an all-new episode. See you later.